Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents that companies don't want you to read too closely. Today we're tackling Fossil Group's latest quarterly report. You know, the watch company, get ready for a bumpy ride because it looks like time might be running out for their turnaround plans. This report paints a picture of declining sales, restructuring efforts, and some serious debt. We'll break down the key numbers, see where Fossil is struggling, and what they're trying to do about it. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for even more in-depth discussion. First up, let's peek at the overall health. We're looking at the report for the period ended April 5, 2025. One of the most important numbers is what people owe them or their accounts receivable, which is down to about $124, to $162.20. People are buying less from them. Their inventory, the stuff they have ready to sell, is at $182 and $1 million, slightly higher than the $178 on $6 million at the end of last year. So less money coming in, but more product sitting around, not a great combo. Their cash and cash equivalents is also down, sitting at $78.3 million compared to $123.6 million at the end of last year. That means they're burning through cash, and that's a worry. Now, the real story is in the income statement. Let's take a look at their sales or net sales. They're at $233 and $3 million, but hold on, we need to remember the 2025 reporting period has one extra week. The prior year, which was a normal 13-week quarter, had $254.9 million in sales. That's a drop even with the extra week in the current report. Their gross profit, which is revenue minus the direct costs of making the stuff they sell, is $143 million, better than the $133.5 million from last year. So they are selling for slightly better margins. The company is trying to cut costs, and that shows in the operating expenses. They're down to $149 from $162.7 million a year ago. But the key number here, the net loss, is still negative. They lost $17.6 million, which is better than the $24.3 million loss from last year. But a loss is still a loss. They're losing about 33 cents for every share in the company. Speaking of shares, let's talk about what the loss means per share. Basic earnings per share, or EPS, is negative 33 cents, which is better than negative 46 cents last year. Diluted EPS is the same, as there were not enough profits to trigger the dilution effect, which makes the math more conservative. Something interesting, currency translation adjustment is up from a negative $2.5 million to $9.3 million. So they are getting a boost from the fluctuation of currency exchange rates. This kind of thing is never the business doing better, just luck. Let's move over to the balance sheet, which is like a financial snapshot, and see how things stack up for the company as of April 5, 2025. To fully appreciate it, you have to compare it against December 28, 2024. You can see this breakdown in the report in a table labeled Condensed Consolidated Statements of Stockholders' Equity. Stock-based compensation is at $641,000, so employees are being rewarded, which often means good things are coming for the company. Net income loss is at negative $17.6 million. So despite all the stock compensation we saw, the company is still losing money. The company gained about $4.1 million due to exchange rate changes on cash. These sorts of gains don't come from any real improvement in the business. Now let's move on to a high-level overview of company actions. It all starts in section Financial Statement Policies. This section states what the rules and accounting practices are of the company. Usually these don't change much from quarter to quarter, so you'll see the same practices being applied. The financial statements also mention what the business is, that being a global design, marketing, and distribution of consumer fashion accessories, with the principal offerings including an extensive line of men's and women's fashion watches and jewelry, handbags, small leather goods, belts, and sunglasses. One thing I was paying particular attention to was selling general and administrative expenses, or SG&A. These were at about $133.8 million. Finally, the last thing mentioned in their financial statement policies is about earnings per share. They calculate it in two ways, basic and diluted. Moving away from financial statements, the report also talks about where the revenue is coming from. Most of the revenue is recognized at a point in time, meaning it's from regular sales of goods. The rest is overtime, which usually has to do with some service that goes along with the goods, and it's only a small number anyway. So far, things have been about money out. So how about how much product is in their stores or warehouses or inventories? At $175 million, the large majority of inventory is finished goods, meaning ready to sell. There is another $7 million for components and parts. So the company is definitely leaning on selling existing product rather than making new things. Next up, warranty liabilities. This is the money they expect to spend fixing or replacing broken products. They paid out about $1.2 million related to warranties. It sounds like the quality of their products might not be the best. The company is issuing fewer warrants now than in 2024, but that might be because they're selling less product. Moving to income taxes. This part is really important. It affects the bottom line. They had an income tax expense of $3.4 million. Compare that to last year, where they had a tax benefit of over $6 million. Having to pay taxes means less profit. The report is quick to mention that the tax rate is greatly affected by foreign countries and deals with international commerce. It's hard to summarize this, but essentially the current tax laws hurt them in this specific quarter. The total amount of unrecognized tax benefits as of April 5, 2025, that's what the company could get back, is about $6.2 million. Let's talk about stockholders' equity. This is ownership in the company. They did not buy back any stock in either quarter. Next up is employee benefit plans. This is how the company rewards its employees. They adopted a 2024 long-term incentive plan with 7 million shares available to be issued. Moving on to accumulated other comprehensive income or loss. I know these names can be daunting. This section is important because it talks about things that haven't actually hit the income statement yet, but are real changes to the financial position of the company. Alright, let's check out where the money comes from with segment information. This is usually broken down by geography. For the period, the Americas brought in $97.7 million, Europe $77.3 million, and Asia $57.3 million. We're seeing the company is following new transparency rules to their income tax information within the income tax footnote. In November 2024, they issued something called Accounting Standards Update ASU 2024-AL3, which will require them to disclose additional information about specific expense categories. This might add some extra steps for the accountants, but it helps people outside the company understand their expenses. One final word about cash. They took on $30, dollars, and $2 million for a net of $14.22 million. A similar story played out the previous year where there was more debt paid than taken. Moving to the management's discussion and analysis of financial condition and results of operations, usually called MD&A by those in the know. I want to point out that company is really trying to say here that world conflicts may continue to weaken the global economy. This is definitely true for a lot of companies right now. As part of their long-term plans, here's a line that caught my attention. Any such grant shall vest 100% on the earlier of 1 year from the date of grant or the date of the company's next annual stockholders meeting, provided such director is providing services to the company or a subsidiary of the company on that date. This can serve as a check to see if people are still aligned with the plan. Then there's also another mention of exchange rate changes. These can go both ways, benefiting and hurting them as a cost for doing business in other countries. And the following table presents segment reporting information by segment. For sales in America, the total is $110 million, with watches contributing over $83 million. Next is a similar table for entity-wide information revenue from external customers by products and services. So putting this all together, it's been 17 weeks. What's the general status? Common stock-free purchase programs had no updates. The company didn't buy or sell its own shares. At 47 minutes, this is just about everything, and here is a table with summary information by operating segment. One area that always matters in these documents is item 1, legal proceedings. In this report, the company says they were not a party to any claims that had a material effect on the financial performance of the company. It's usually the case, but it's important to check. One of the most important sections, item 1A, risk factors. It's always good to check to see if any of the company is saying its problems will impact its stock price and credit worthiness. One thing mentioned is we are highly leveraged. Leveraged here means debt, and as it says, a high level of debt could adversely affect our competitiveness, meaning other companies don't need to worry so much about paying debt, and so they can be more competitive. Here's the summary on a high level. From the risk factors, they may limit our ability to retain additional financing or sell stock. They may limit our flexibility. They are more highly leveraged than some of our competitors. They may make us more vulnerable to a downturn in our business. They may increase our cost of borrowing. They may limit our ability to retain additional financing or sell stock. They may limit our flexibility. They are more highly leveraged than some of our competitors. They may make us more vulnerable to a downturn in our business. They may increase our cost of borrowing. They may limit our ability to refinance, require to dedicate a substantial portion of our cash flow to service our debt, and finally, there would be a material adverse effect on our business. They may increase our cost of borrowing. They may limit our ability to refinance, require to dedicate a substantial portion. Speaking of problems, there is lack of actions to do any or all the following, including cash flow and improve working capital. This is another risk, which is not being able to come up with action plans. The lack of coming up with ideas to change their ways could prevent us from achieving profitability or maintaining sufficient levels of liquidity. So what's the call here? The report makes one thing clear. The company is operating in a tough space. Sales are down, debt is high, and they're working on a turnaround plan. What they have going for them is that they are profitable enough to keep working on improving, but they still got far to go. There's potential, but they need to execute perfectly to turn things around. Alright, that's our breakdown of Fossil's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.